Here's what I'm watching right now, and it should send chills down your spine. McDonald's, the company that built an empire on affordable food, the place where anyone could get a meal regardless of their economic situation, is struggling to sell burgers. When the Golden Arches start seeing traffic decline and customers walking away because they can't afford a Big Mac, we're not just talking about one company's problems. We're talking about a fundamental breakdown in consumer purchasing power that signals something deeply wrong with the economy. Let me walk you through exactly what's happening, why it matters more than almost any economic indicator you're watching, and what this tells us about where we're headed. McDonald's just reported comparable store sales that missed expectations, with U.S. traffic declining for multiple consecutive quarters. Now, you might think, so what? Restaurant sales fluctuate all the time. But that misses the critical point about what McDonald's represents in the economic food chain. This isn't a high-end steakhouse seeing fewer reservations or a trendy fast casual concept losing its appeal. This is McDonald's, the baseline, the floor, the place people turn to when they need cheap calories. When McDonald's struggles, it means consumers are so financially stressed, they're cutting back on the most basic discretionary spending. They're not trading down from sit-down restaurants to fast food. They're already at fast food, and now they can't even afford that. They're trading down from McDonald's to what? Eating at home exclusively? Food banks? This is the economic equivalent of the canary dying in the coal mine. The mechanics of what's driving this are critical to understand. Over the past 3 years, McDonald's has raised prices significantly. A Big Mac that cost maybe $4.50 in 2019 now costs $7 or more in many markets. That's a roughly 55% increase. For a family of four, what used to be a $20 meal is now $35, $40. McDonald's corporate will tell you they had to raise prices due to input cost inflation. Beef, labor, rent, utilities all went up. And that's true. But here's what they're not telling you. They raised prices faster than their core customer base's wages increased. The low to middle income consumer that McDonald's depends on saw maybe 15-20% wage growth over that same period, while their essential costs, rent, gas, insurance, groceries, went up 30 to 50%. So by the time they're considering McDonald's, the math just doesn't work anymore. That value proposition McDonald's built its brand on has evaporated. A family looking at their budget says, I can buy ground beef and buns for $12 and feed everyone at home, or I can spend $40 at McDonald's. The choice becomes obvious when you're financially squeezed. What makes this particularly concerning is McDonald's response. They've tried to bring back value offerings, limited time meal deals, app-based promotions, McValue menu expansions. But here's the problem. These value offerings are still more expensive than what McDonald's used to charge for regular menu items just a few years ago. The $5 meal deal they're promoting would have been considered expensive in 2020. So even their attempts to recapture price-sensitive customers aren't working because consumers are so tapped out that even the value options feel unaffordable. This tells me the financial stress isn't marginal, it's deep and widespread. We're not talking about consumers being a little more careful with discretionary spending. We're talking about broad swaths of the population being priced out of fast food entirely. The demographics of who's pulling back from McDonald's are revealing. This isn't wealthy consumers deciding to eat healthier or choosing premium burger concepts. McDonald's customer base skews toward lower income households, families with children, and younger consumers. These are the groups that have been hit hardest by inflation, especially in housing and transportation costs. When you're choosing between paying rent, putting gas in your car to get to work, or buying your kids McDonald's for dinner, McDonald's loses. Every time. And the fact that millions of families are now making that choice tells us that household budgets are breaking under the strain of persistent inflation that wages haven't kept pace with. The savings buffers that carried people through 2021, 2022 are gone. The credit cards are maxed out. And now we're at the stage where people can't afford basic conveniences like fast food. Let's talk about what this means for the labor market, because the connection is direct and ominous. McDonald's is one of the largest employers in the country. They employ roughly 200,000 people directly. And when you include franchisees, that number exceeds 2 million globally. When McDonald's sees sustained traffic declines, franchisees respond by cutting labor hours. They schedule fewer workers per shift. They reduce operating hours. They delay hiring. Some close locations entirely. This creates a direct feedback loop. Consumer financial stress leads to reduced spending at places like McDonald's, which leads to reduced hours and income for McDonald's workers, which further reduces their spending capacity, which deepens the economic slowdown. It's textbook recession dynamics playing out in real time, and McDonald's sits right at the nexus of this feedback loop. Now, I want you to consider the political implications of what's happening, because this goes beyond economics into dangerous social territory. For decades, the American social contract included an implicit promise. If you work hard, you should be able to afford basic necessities and occasional small pleasures. A McDonald's meal represents one of those small pleasures. It's not extravagant, it's not luxury, but it's a treat for kids, a convenient option when you're tired, a small reward for making it through a tough week. When working families can no longer afford even that basic level of discretionary spending, resentment builds. They look at wealth inequality data showing billionaires adding hundreds of billions to their net worth while they can't afford a happy meal for their kid without feeling financial stress. This isn't sustainable politically. We're creating the conditions for serious social instability when the working class feels completely left behind and locked out of even modest participation in consumer culture. The McDonald's situation also exposes the lie behind the soft landing narrative that policymakers and Wall Street keep pushing. They point to GDP growth, low unemployment rates, and moderating inflation as evidence the economy is fine. But McDonald's traffic data tells a different story. It tells us that millions of households are experiencing economic conditions that feel nothing like a soft landing. They're experiencing what feels like a recession, cutting spending, struggling with bills, watching their purchasing power erode month after month. The aggregate data might look acceptable, but the lived experience for a huge portion of the population is economic stress and declining living standards. McDonald's declining traffic is a real-time indicator of that stress, and it's far more reliable than lagging government statistics that get revised months later. From an investment perspective, this carries serious implications that extend well beyond McDonald's stock price. If consumers can't afford McDonald's, they're pulling back across the entire consumer discretionary sector. Retailers are going to see traffic declines. Other restaurant chains are feeling the same pressure. Anything that requires discretionary spending is at risk. This is why we're seeing companies like Target, Walmart, and Dollar General all reporting traffic softness and providing cautious guidance. The consumer, which drives 70% of U.S. GDP, is tapped out. And when the consumer is tapped out, corporate earnings across vast swaths of the economy are at risk of disappointing expectations. The stock market has priced in continued consumer resilience and steady earnings growth, but the McDonald's data suggests that assumption could be wrong, and when the market reprices for weaker consumer spending, the correction could be swift and severe. The deflationary psychology that's starting to emerge is something I'm watching very carefully. When consumers see prices at McDonald's and think, that's too expensive, I'll wait, or I'll skip it entirely, they're exhibiting deflationary behavior, delaying purchases in the expectation that they either can't afford current prices or that prices might come down. Once that psychology takes hold broadly, it becomes self-reinforcing. Businesses see reduced demand and start discounting. Consumers see discounting and delay purchases further, waiting for even better deals. Revenue falls, companies cut costs including labor, unemployment rises, and spending falls further. It's the deflationary spiral that Japan experienced in the 1990s and struggled with for decades. The fact that we're seeing early signs of this psychology at the consumer level, particularly at price-sensitive businesses like McDonald's, should be setting off alarm bells at the Federal Reserve. Let me connect this to the broader credit cycle, because that's where the systemic risk builds. Consumer spending over the past few years was supported by credit cards, buy now, pay later schemes, auto loans, personal loans. Consumers borrowed to maintain spending levels that their income couldn't support. We can see this in the data. Credit card balances at record highs, auto loan balances at record highs, delinquency rates rising across consumer credit categories. McDonald's traffic decline tells us we're reaching the end of that credit-fueled spending. Consumers can't take on more debt. They're already over-leveraged, and they can't maintain current spending from income because inflation has exceeded wage growth. So spending has to contract. When consumer spending contracts, business revenues fall, which leads to cost-cutting and layoffs, which further reduces income and spending. This is how credit cycles end. Not with dramatic crashes necessarily, but with a grinding contraction as over-leveraged consumers and businesses work off debt and reduce spending. McDonald's is showing us we're entering that phase. The policy response to this situation is going to be fascinating to watch, and I say that with a sense of dread. The Federal Reserve has started cutting rates, but rate cuts don't help consumers who are already over-leveraged. Lower rates might reduce their debt service costs marginally, but it doesn't restore the purchasing power they've lost to inflation. What consumers need is either significant wage increases or deflation in the prices they pay for essentials. But wage increases create inflation concerns, and deflation creates recession concerns. So policymakers are trapped. They can't fix the consumer's problem without creating other problems. This is the corner they've painted themselves into by allowing inflation to run hot for so long and by encouraging debt-fueled consumption as the primary engine of economic growth. Politically, this becomes explosive material. When working families can't afford McDonald's, they're going to look for someone to blame. Politicians will point fingers at corporations for price gouging, at the Federal Reserve for policy mistakes, at opposing parties for wrong economic policies. But the underlying issue is structural. We've built an economy dependent on continuous consumption growth fueled by debt, with real wage growth lagging productivity gains and asset appreciation benefiting a narrow slice of the population. McDonald's traffic decline is a symptom of that structural problem, and no amount of political finger-pointing fixes it without addressing the underlying wealth distribution and debt dynamics. The international implications deserve consideration as well. McDonald's is a global company, and consumer stress in the U.S. tends to presage similar dynamics in other developed economies. If American consumers are pulling back from discretionary spending, European and Asian consumers are likely experiencing similar pressures. This creates synchronized global slowdown risk, multiple major economies seeing consumer retrenchment simultaneously. That's the recipe for global recession, and it's far harder to fight with monetary policy when it's happening across multiple economies at once. Central banks can't all ease aggressively without creating currency instability and inflation risks. The coordination problems become immense. Looking at McDonald's specifically, the company will likely survive this period. They have strong brand equity, global scale, and the ability to adjust their strategy, but the smaller franchisees are going to face serious stress. Many franchisees operate on thin margins even in good times. When traffic falls and they can't raise prices further without losing more customers, those margins evaporate. We're likely to see franchisee bankruptcies, location closures, and consolidation in the franchise system. This has employment implications. Closed locations mean lost jobs, and it has community implications, as McDonald's locations often serve as gathering places and employment centers in lower-income communities. The historical parallels are worth examining. In previous recessions, we've seen fast food hold up relatively well because consumers trade down for more expensive dining options. But this time feels different because consumers are already at the bottom of the dining spectrum. There's nowhere left to trade down to except not eating out at all. This suggests the coming slowdown could be more severe than typical recessions because the consumer has less flexibility and fewer buffers. They've already cut back on everything except essentials, and now they're cutting back on things like McDonald's that used to be considered affordable basics. When you're cutting that deep, the economic impact spreads widely and quickly. The wealth inequality angle keeps coming back to me because it's so stark. We have a situation where billionaires are literally flying to space for recreation, while working families are skipping McDonald's because it's become too expensive. That's not just an economic issue, it's a moral and social issue, and it's unsustainable. History shows us that when inequality reaches extreme levels and the working class feels economically hopeless, social stability breaks down. We're not there yet, but we can see the path. McDonald's traffic decline is an early warning that we're moving in that direction. When people can't afford basic participation in the economy, they lose faith in the system. That's when you get political upheaval, social unrest, and potentially dangerous political movements that promise simple solutions to complex problems. From a market's perspective, I keep thinking about what happens when the consumer finally breaks. We've had multiple false alarms over the past few years, times when it looked like consumer spending was about to collapse, but then it didn't because consumers found another source of credit or drew down another buffer. But McDonald's data suggests we may be running out of those buffers. When the consumer actually does pull back materially, the market is going to be shocked because the entire bull market thesis has been built on consumer resilience. Earnings expectations, valuations, growth forecasts all assume the consumer keeps spending. When that assumption breaks, we could see a very rapid repricing across equity markets, particularly in consumer discretionary names, but spreading to other sectors as the growth implications become clear. The feedback loops worry me most. Reduced consumer spending leads to lower corporate revenues, which leads to cost-cutting and layoffs, which leads to reduced consumer income, which leads to further spending cuts. Once that cycle starts, It's very difficult to stop without massive policy intervention, and we're already in an environment where policy options are limited, interest rates are still relatively low historically, government debt levels are high, limiting fiscal space, and public trust in institutions is low, making coordinated policy responses difficult. McDonald's traffic decline suggests we may be at the start of that negative feedback loop, and I'm not confident policymakers have the tools or the political capital to break it. Let me be clear about what I'm not saying. I'm not predicting McDonald's goes bankrupt or that we're definitely heading into a depression. What I am saying is that McDonald's traffic decline is a significant leading indicator that consumer financial stress is reaching critical levels. It's telling us that large numbers of households have cut spending so deeply that they can't afford basic fast food. That's not normal. That's not healthy. And historically, when we see consumers, this stressed, broader economic weakness follows. Whether that weakness becomes a mild recession or something worse depends on how policymakers respond, how much further consumers can cut spending, and whether we get any positive shocks that change the trajectory. But the McDonald's data points us toward more economic pain ahead, not less. The class dynamics of this situation are impossible to ignore. The people who can no longer afford McDonald's are disproportionately working class, living paycheck to paycheck, employed in service sector jobs with limited wage growth. Meanwhile, the investor class that owns McDonald's stock and the executives running the company have seen their wealth and compensation continue to grow even as their core customers struggle. This creates a moral hazard where the people making decisions about pricing and business strategy are completely insulated from the consequences of those decisions. They don't feel the pain of a $7 Big Mac because that's a rounding error in their budget, but for their customers, it's a real choice with real consequences. This disconnect between the decision makers and the affected population is a recipe for poor outcomes and growing resentment. Looking ahead, I'm watching several things closely. First, McDonald's continued traffic trends. Do they stabilize, improve, or continue deteriorating? Second, how other value-oriented restaurant chains perform. Is this McDonald's specific or industry-wide? Third, consumer credit metrics. Are delinquencies accelerating, suggesting even more severe spending constraints coming? Fourth, labor market data. Are we seeing layoffs accelerate, particularly in consumer-facing sectors? And fifth, political rhetoric. Are we seeing increased populist anger about affordability and inequality? All of these data points together will tell us whether McDonald's traffic decline is an isolated issue or a leading indicator of a broader economic turning point. The tragedy in all of this is that it's largely self-inflicted. We pursued policies that prioritized asset price inflation and corporate profits over wage growth and affordability. We allowed housing costs to spiral. We encouraged debt accumulation as a substitute for real income growth. We tolerated increasing concentration of wealth and market power, and now we're seeing the inevitable consequences. Consumers who can't afford basic goods and services, economic fragility, and growing social tensions. McDonald's struggling to sell burgers is just one visible manifestation of these deeper structural problems. Until we address those structural issues, wealth distribution, real wage growth, housing affordability, healthcare costs, education costs, we're going to keep seeing symptoms like this pop up across the economy. This content is for educational and informational purposes only and does not constitute financial, investment, or economic advice. The analysis presented represents my interpretation of publicly available data and should not be relied upon for making financial decisions. Economic conditions are complex and can change rapidly. Anyone considering financial decisions should conduct their own thorough research and consult with qualified professionals appropriate to their specific circumstances and needs.